Happy Good Friday, everybody. Today is April 15th, and on today's weekly market monitor, we're going to be taking a look at the spring market forecast, taking a look at some stats and trends going on around the country, kind of taking a macro look and then applying that to New Jersey and our specific local counties here. And also want to look at the impact of the rising mortgage rates on people's buying power and what that's doing to the market. So I have some slides to share with you today, as I like to do here at least once a month. So let me share my screen. All right, here we are, halfway through April already. Let's take a look at mortgage rates real quick, shall we? All right, so as you know, if you've been following this, we have had about a 1.5 point increase in the 30-year fixed mortgage rate from the beginning of the year to now, or at least the end of March. It started off right in the beginning of January, just over 3%, 3.11 average nationally, and now we're in the high fours. So we have had about 1.5% increase from the beginning of January until today. The chief economist at Freddie Mac says mortgage rates are likely to continue to move higher throughout the balance of 2020, although the pace of rate increases is likely to moderate. Much of the increases in rate in early 2022 is in anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. So what that's basically saying is that although they've been increasing rather quickly here in the past 3 months since the beginning of the year, and although they are probably going to continue to go up, it will be at a much slower rate. At least that's what they're anticipating. So we can count on that. Impact of rising rates on home prices. So here I kind of have a series of slides, and we're going to add a piece of data into each one that is pretty interesting. But this is something I shared last week, and now I've expounded upon this and just to kind of show everyone what this means in various areas of the housing market. So let's look at the past, 6 times that mortgage rates have risen by more than 1%. And just remember to keep in mind, right about 1.5 right now. So here, starting in 1994, 96, 2000, 2004, 2006, and 2013, all of them increased at least a percentage point. In 93 to 94, it was quite a bit. But look at what the impact it had on home prices. None of those years or in none of those circumstances did home prices actually end up falling. And on average, they went up 8% over that time frame. That's what we're still seeing right now. So we are not breaking that trend here at all. Let's take this out a little step further and look at the number of home sales. So across the board, except for 2003, the number of home sales actually went down. So what that basically means is that those rising mortgage rates are and have taken buyers, off out of the market. People that can, most likely can barely afford that house that they're looking at or the home that they want to buy, end up staying where they are, because when that mortgage rate goes up and their buying power goes down, a certain number of buyers drop out of the market. So even though home prices go up and, basically the cost of your house or the value of your house is appreciating, the number of buyers that stay in the market drop. On average, there by 5% out of all 6 of those years or 6 of those times that this happened in the past. Some by quite a bit. But what I'd like to do here is, in 93 to 94, this is kind of one of the 2 outliers where the mortgage rate increase was well over 2%. Like I said, right now we're only at 1.5, and I don't think, no projections I've seen or data that I've seen so far is projected to get us that high, or at least anytime soon. So let's take that one out, shall we? And we'll just look at the ones that are more relevant and more likely or more like our situation right now. So we're going to take out that 93 to 94 time period. Let's look at the others. So on average here, the number of home sales dropped by 4%. And I also want to point out that one of these statistics, the other big outlier, that red, minus 14%, was the last few years building up to the housing crisis. So that is another outlier there, where our circumstances and our situation right now is nothing like that. So if we were to take out that 14%, the averages there are, about a little bit less than 2% of buyers dropping out of the market. The average there is 2. And then there was 1 year between 2003 and 2004 where actually more people got into the market. So that average is actually much lower if we don't think about that other anomaly there of the leading up to the housing crisis in 2005 and 6. And then let's just look out one more column here, months of inventory. So this really only goes back about 15 years. We don't have a data set for before 2000 or 2003. But if we look at these over the past 15 years, the last 3 times that mortgage rates went up by more than 1%, months of inventory, and again, that is also AKA absorption rate. So real quick, if no other homes were to come on the market, it would take this many months for all the supply to be absorbed or, purchased or taken off the market. So in all 3 of these last circumstances, months of inventory has been 5, 4.5, and 4.8. I just want to actually compare this to what we're looking at here right now, which is a bit different. So we're looking at the entire state here, months of inventory for this is single family homes. We're right now in 2022, at least the end of February, at 1.7 months. So less than half of what those other three examples were. And in the townhouse market or condo market here, like apartments, we're at 2. So that's for the entire state of New Jersey. In Hudson County, single families month of inventory right now, or at least the last time this data was collected at the end of February, 2.3 and 3.3. So both less than the national example. And in Bergen County, months of inventory on single family houses, 1.4, super low, and condo townhouses at 2.2. And then I just want to look at Hoboken here real quick. Single family houses at 1.4 and condos at 1.7. So, let's jump back into this presentation here, but that tells me a lot. I mean, when your inventory is going that quickly, it really shows that demand is super high and inventory is very low. And nationally, that is what we're looking at here. And okay, before I go on, nationally, that's what we're looking at. Very low inventory, very high supply. We just can't keep up. And then in very urban areas like we are right here in northern New Jersey, that's even more extreme. Much higher demand, even lower supply at, like you saw in Hoboken, 1.7 and 1.4. Pretty crazy. So my final thought here before I move on is just that although mortgage rates are increasing, home prices are still going up because we have that upward pressure from the lack of inventory on the market. So the number of buyers will continue to drop out as mortgage rates increase, but that doesn't necessarily mean, or in any circumstances in the past, point at home values to actually lessen or decrease. All right, let's take another quote here from the Director of Forecasting at the National Association of Realtors, or NAR. While higher short-term interest rates will push up mortgage rates, I expect some of this impact will be mitigated eventually through lower inflation. Thus, I expect the 30-year fixed mortgage rate to continue to rise, although we aren't likely to see the big jumps that occurred over the past few weeks. Basically, what another person saying what we heard before. And over at Freddie Mac, obviously one of the big lenders here, history suggests that when rates rise, there's an initial bump in home prices, as many move quickly to buy a home before rates increase further. But after that period, home prices slow. Freddie Mac analysis shows that 1% increase in mortgage rates results in home price appreciation that is 4% lower, 4 percentage points lower. So for instance, for example, in a 1% increase in mortgage rates would change home price growth from 11% to 7%. And that is actually pretty accurate for the nationwide statistic. So home price appreciation has been going up pretty quickly. And although mortgage rates are slowly increasing, it doesn't mean that home prices are going to depreciate. And I talked about this maybe 2 weeks ago. It's going to decelerate. So instead of going up super fast, it's just going to go up a little bit slower. All right, let's get into the spring housing market update, shall we? A research firm called Altos said, we keep watching for it, but there are absolutely no signs of a market slowdown anywhere in the data. If anything, we're seeing the market continue to heat up. Buyer traffic index really illustrates this. So from February here, buyer traffic is strong to very strong across the country, or at least stable. Stable is kind of the minority here in some of the Midwest areas and West areas, and then across the country it is strong. Contrarily, seller traffic, or the number of listings that are coming onto the market, is basically stable in a few outliers, weak in most areas, and then very weak in many areas as well. Again, demand and supply. All right, active listings increased for the first time in 6 months. Active listings monthly in thousands. So again, this is nationwide. But since you can see it there, kind of peaked in September, the number of active listings that were coming on the market were steadily decreasing over the past 6 months. And then in March, we finally saw just a little uptick for the first time in those 6 months, active listings actually increasing heading into the spring market, which is always good to see. So the editorial director at Fortune magazine said, now more industry insiders are throwing out their previous forecasts and replacing them with more bullish short-term outlooks. Indeed, some experts say that 2022 spring housing market might go down as one of the most competitive on record. And I would argue that the Q1 of 2022 and even Q4 of 2021 was pretty freaking crazy. If you are, a buyer out in any of the suburban areas around here, you know that things are selling for like hundreds of thousands of dollars over asking price, with the number of offers well into the double digits. Showings exceed pre-pandemic numbers. So this is the showing index over the past 5 Februaries, being pretty normal or average in 2008, 2018, 2019, 2020. Remember, February was like right in the cusp, right before the pandemic started and things started shutting down. So I would say, the average for those years is the average we should be looking at, right about 145, let's say. And now, it increased huge last year in 2022, and it went up even more in 2022. So crazy number of buyers out there in the market looking, lots of showings. So price appreciation accelerating percent. This is a percentage year over year increases monthly. Again, this is nationwide, starting with January. So, almost a year and a half ago, January 2021, price appreciation going up quite a bit in April, May, and June last year, leveling off in the later half of the year, right around 18. And then it just took off again right at the beginning of this year from 18.5 to 19.1. The managing director at S&P says, last fall we observed that Last fall we observed that home prices, although continuing to rise quite sharply, had begun to decelerate. Even the modest deceleration was on pause in January. The 19.2 year-over-year change for January was the fourth largest reading in 35 years of history. So more new listings than active listings. Well, let's look at it right here. Active versus new. So let's kind of define that. Active listing rolling into a new month. So when you look at all the months down here, an active listing is something that is already on the market. And then when you roll into the new month, it is still for sale. New listings are the things that are coming onto the market in that month at the bottom. So every month that we're going back here, August, September, October, November, December, January, and even February, all those, even though that gap was getting smaller, there were more active listings than new listings going in. Now we flipped a little bit. Just this last month, the active listings was outpaced by new listings. So that's a good thing to see. It means that the inventory that is out there is getting sold, but that heading into the spring and summer market, more people are looking to list their homes, which is something we desperately need. So this is a graph showing new development single-family houses new single-family houses that are being built. What you want to look at here is, see that dotted line is the average annual units completed. So that's, floating right there in the middle. The 70s was a huge time in a relatively normal market where people were just building houses across the country like crazy. You can see basically 7 out of the 10 years in the 70s, there were more than the average number of units being built. So basically increasing that supply across the country. And then throughout the 80s and 90s into the 2000s, it was right around average. We have the outliers there in red, leading up to and into the housing crisis. People were building a lot of houses because everyone was buying them for the obvious reason that I don't want to get into. But anyway, the reason why we're looking at this is because over the past 15 years here, 14 straight years in a row, the number of new development or homes that are coming on as new development has been well below average. So it's basically just showing here in graph form that the number of new development homes is just not keeping pace. It's well below the average. Demand is huge and supply is mostly coming in the form of resales, which is how homes that already exist, people selling them and moving out, and then a new person coming in rather than being developed. So not a big help to our housing supply issue. Home ownership is a hedge against inflation. It certainly is. So home price appreciation versus CPI, or consumer price increases over the decades. So going back to the 70s, every decade here, the inflation rate is in blue, and then home price appreciation is in green. Every year, their home price appreciation is basically outpaced. And in the couple of decades in the 80s and the 2000s, where inflation rate was more than home price appreciation, it was by very, very little. So in the 80s, it was by 0.1%. And in the 2000s, it was by 0.3%. Every other year, especially last year, home price appreciation was almost triple what the inflation rate was. So although we are kind of going through a lot of inflation right now, home prices are still going up. So if you own a home, good for you. If you're getting into the market, good for you as well. Here, I love this stat: potential growth in household wealth over the next 5 years based solely on increasing home equity. So not looking at anyone's job, income, or anything like that. Is basically, if you buy a house today, in the average, let's say the average sale price across the country is $360,000. This is how much potential growth in household wealth you could have just on your asset. of a house. So if you buy the average house in average town America for the average price of 360,000 over the next 5 years into 2027, you could potentially add over $96,000 just by the price appreciation and value appreciation of that asset. And if I like this stat even more when I think about the average home price in our area being well above that, you stand to pretty much double that. And in a lot of cases, a lot more. So I'm just going to leave that out there for you guys. The home price forecast for just the rest of this year, based off of 7 or 8 of the big players in the real estate industry, everyone is projecting a pretty big increase in appreciation, and the average being 6.7% out of all of these. No one is projecting a decrease, which is great to see. So that's all I have for you today. I hope everyone enjoyed that and makes you feel nice and warm and cozy about your home purchase or potential home purchase heading into this nice holiday weekend. Thank you so much for being here. I'll be back next week, next Friday, as always, on your weekly market monitor. And if you have any questions, anything you want to hear about or anything you want to go over with me about this, I'm always happy to hear from you guys. You can reach me on my cell phone. It's 617-851-9141, or via email as well. It's brian.mccarthy@compass.com. Thanks again. Have a great weekend, everybody, and I will see you next time.